Welcome back to another video lecture of Financial Derivative and Risk Management. In our previous class, we discussed about the swap contract, and in that we learned that what is a swap contract and how it is been done. And in that we had also learned that there are various types of swaps. So, in today's class we will be discussing in detail about the different types of swaps that are available in the derivative market. As we have known that these swaps are OTC instruments, or we can say that it is traded over the counter, and these swaps are basically been taken, or these are basically been done by the institutional investors. So, to know more about the types of swap, let us start our today's class. So, as we know, these swaps are derivative instruments that represent an agreement between two parties to exchange a series of cash flows over a specific period of time. And generally, we know that the swaps could be of three types, that are the interest rate swap, currency swap and the basis swap. So, these are the general types of swap that we are having. And this interest rate swap, what we know, in which the counterparties agree to exchange one stream of future interest payments for another based on a predetermined national principal amount. So, generally interest rate swaps involve the exchange of a fixed interest rate for a floating interest rate. So, as we have said that, as the name suggests, interest rate swap are the swapping of two different interest rates. So, as we know, basically there could be two interest rates that are available. It might be a fixed interest rate or it might be a floating interest rate. So, when we have a fixed interest rate, that means what? We have a fixed rate of interest on that particular instrument which we have to pay throughout that particular fixed interest. But when we are talking of floating interest, there is fluctuation in the rate of interest. So, many a times there is a dilemma, or there is a regret, or we can say that there is a seeking of another type of interest rate by the investor. So, the one who is having a fixed rate of interest might find that the flexible rate of interest or the floating rate of interest is lower than its fixed rate and want to swap it with that floating rate. On the other hand, it might happen that the fluctuation in the interest rate that is there in the floating rate is getting higher than a fixed rate of interest that is prevailing. So, the floating rate interest rate the investor who is paying will likely to swap it with the fixed rate. So, this desire of having the other type of interest rate which the investor is not having the facility to have, when it is being swapped, that is known as the interest rate swap. So, that is what the interest rate swap is. So, it is simply a rate swap what we are saying, and is which an agreement between two parties to exchange a sequence of interest payments without exchanging the underlying debt is done. In a typical fixed or a floating rate swap, the first party promises to pay to the second at designated intervals a stipulated amount of interest calculated at a fixed rate on the national principal. The second party promises to pay to the first at the same intervals a floating amount of interest on the national principal calculated according to a floating rate interest. So, the interest rate swap is essentially a strip of forward contracts exchanging interest payments. Thus, these interest rate swaps like interest rate futures or interest rate forward contracts offer a mechanism for restructuring cash flows, and if properly used, provide a financial instrument for hedging against this interest rate risk that is there. So, with the bank as a intermediary and each party deals with the bank rather than each other, interest rate swaps can be categorized as fixed to floating, floating to fixed, and another one is there which is floating to floating. So, this fixed to floating is the rate swaps. The party pays fixed rate of interest to the bank or a swap dealer, and in exchange receives a floating rate interest determined on the basis of reference or benchmark rate at predetermined intervals of time. So, such a swap is used by a firm which has floating rate liability and it anticipated a rise in the interest rate. So, through the swaps, the firm will cancel out the receipt and payments of floating rate and have cash outflow based on the fixed rate of interest. Another type is the floating to fixed. So, in this kind of swap, the party pays floating rate of interest to the bank or swap dealer and in exchange receives a fixed in rate interest at predetermined intervals of time. So, such a swap is used by a firm who has fixed rate liability and it anticipates a fall in the interest rate. So, through the swap, the firm will cancel out the receipts and payments of fixed rate liability and have cash outflow based on the floating rate of interest. Other is the float to float, and in that companies sometimes enter into a swap to change the type or tenure of the index that they pay, and this is known as a basis swap also. And a company can swap from 3-month LIBOR to 6-month LIBOR, for example, either because the rate is more attractive or it matches other payment flows. And a company can also switch to a different index such as the federal funds rate, commercial paper or the treasury bill rate. So, this could be the types. Apart from that, there are other different types of interest rate swaps that are a plain vanilla swap, a basis swap, an amortizing swap, step up swap, extendable swap, delayed start swaps or deferred swaps or forward swaps and differential swaps. So, let us have a look on these types of swaps. First, we will start with a plain vanilla swap. So, this is the simplest form of interest rate swaps where a fixed rate is exchanged for a floating rate or the vice versa on a given national price at pre-agreed interval during the life of the contract. So, this is what a plain vanilla swap is. Other is a basis swap. So, in a floating to floating swap, it is possibly to exchange the floating rate based on different benchmark rates, and this is what a basis swap is, in which we are having the type that is the floating to floating swap type. Another one is an amortizing swap, as the name suggests, swaps that provide for reduction in national principal amount corresponding to the amortization of a loan are called amortizing swaps. Next, we have step up swap. So, in step up swap, this is the opposite of an amortizing swap. In this variety, the national principal increases as per a pre-agreed schedule. So, this is just the opposite of the amortizing swap, that is what step up swap is. Then we have extendable swap. So, when one of the counterparties has the right to extend the maturity of the swap beyond its original life, the swap is said to be an extendable swap. So, when we can extend the time period or when we can take it further of the maturity period, then we are calling that as the extendable swap when we are extending it. Then we have delayed start swaps, deferred swaps or the forward swaps. So, when it is agreed between the counterparties that the swap will come into effect on a future date, it is termed as a delayed stat swap or a deferred swap or a forward swap. So, when there is a delay in the swap or when we agree between the counterparties that the swap will come after some time or it will be effected on a future date, not now, and when it is delayed or deferred, what we are saying, or it is taken forward, it is known as the delayed start swaps. When there is a delay in the starting of this type of swap, according to that we name it as a delayed start swap, or we also call it as a deferred swap, or we also call it as a forward swap. Apart from that, the other type of swap that we are having is the differential swap. So, the interest rate swaps which are structured in such a way that one leg of the swap provides for payment of interest at a rate pertaining to a currency other than the currency of the underlying principal amount, and the other leg provides for payment of interest at the rate the currency of the underlying principal. This is known as the differential swaps. When we can say that when there is differentiality or difference of underlying principal is there, that swap is known as the differential swap. And apart from this interest rate swap, we have currency swap, and in currency swap what we are having, in currency swap it is a transaction in which two parties exchange an equivalent amount of money with each other, but in different currencies. So, when currency is the underlying asset, or we can say that the type of currency is being swapped between two counterparties, that is the currency swap. So, what this currency swap is, if you will see in this, two parties exchange equivalent amount of two different currencies and trade back at a later specified date, and these currency swaps are often offsetting loans, and the two sides often pay each other interest on amounts that is exchanged. And these financial institutions conduct most of the foreign exchange swaps, often on behalf of a non-financial corporation, and these swaps can be used to hedge against exchange rate risk, speculate on currency moves, and borrow foreign exchange at lower interest rates. So, this is what the currency swap is. So, what we learned is the different types of interest rate swap and the currency swap that are there. So, these are the generally traded financial derivative swap type. So, these are the types of swaps that are generally traded and adopted by the investors. Apart from this generally traded financial derivatives or financial swaps, what we say in specific, there are few other types of swaps that are also available, that are like the commodity swap. So, what a commodity swap is, that in which we exchange the commodities between two companies or individuals or institutions. So, like for example, we can say the crude oil barrels that are being exchanged between two companies are the commodity swaps, and these commodity swaps are generally adopted or taken by the companies, those who are producing or using the raw materials. So, what this commodity swap is, let us have a look on that. So, these commodity swaps are common among the individuals or companies that use raw materials to produce goods or finished products, and these commodity swaps are effective hedging tools against variations in commodity prices or against variation in spreads between the financial product and the raw material prices. So, this is what the other type of swap, that is the commodity swap, is. Apart from that, we have another type of swap, that is credit default swap. So, this credit default swap offers insurance in case of default by a third party borrower, and this CDS or the credit default swap works as insurance to protect lenders and bond holders from borrowers' default risk. So, as it is protecting or is giving the facility of swapping of the default risks that is there in case of the bond holders from the borrowers, it is named as the credit default After that, we have another type of swap, that is the zero coupon swap, and this zero coupon swap is similar to the interest rate swap, and this zero coupon offers flexibility to one of the parties in the swap transaction. And in a fixed to floating zero coupon swap, the fixed rate cash flows are not paid periodically, but just once at the end of the maturity of the swap contract. And the other party who pays a floating rate keeps making regular periodic payments following the standard swap payment schedule. And in a fixed zero coupon swap is also available, and wherein one party does not make any interim payments, but the other party keeps paying fixed payments as per the schedule. So, this is what the zero coupon swap is. And another type of swap that we are having is the total return swap. So, in a total return swap, the total return from an asset is exchanged for a fixed interest rate, and this gives the party paying the fixed rate exposure to the underlying asset and a stock or an index. For example, we can say an investor could pay a fixed rate to one party in return for the capital appreciation plus dividend payment of a pool of stocks. So, that is what the total return swap is. So, apart from these interest rate swap which are commonly known, and the currency swap which is generally been adopted by the various investors to hedge the risk of the foreign exchange exposure, there are these different types of swaps that are available that we have discussed in today's class. So, that might be a total return swap, that might be a credit default swap, that might be a zero coupon swap. So, these are the various other types of swaps that are available to the investors to invest in this type of financial derivative. So, in today's class, we discussed in detail about the interest rate swap, what are the different interest rate swaps that are available, either it is fixed to floating, floating to fixed, floating to floating rate of swap or rate swaps what we are saying. We also discussed about the currency swap and what are the important and key features and things of the currency swap, and also we discussed the other different types of swaps available in the financial derivative market. So, in today's class we had a wide and vivid knowledge on the types of swaps in financial derivative. In our further classes, we will be discussing many other topics of financial derivative. Keep watching. Thank you.